Francisco, it's great to see you. And my bearishness on oil now must itself be a sign that prices are about to take off again. What do you see?
Hey, Kelly. We agree. We think prices are going to be higher. We're still targeting $110 a barrel on Brent for next year, probably sometime in the third quarter of next year. But obviously, it's going to be a little challenging for oil over the course of the next few months as hospitals in Shanghai and other parts of China essentially build up with a lot of COVID cases and likely pull back demand in the short run. Yeah. But we think that after the Chinese New Year, demand will start to pick up there.
But it's been,
and obviously, yeah.
Francisco, yeah. The oil price collapse has been pretty spectacular. And we had Ed Morris on the other day who kind of called it and is still pretty bearish. What is the case for this not being a new normal? You know, why don't you think we could have prices stay down here around these levels into the first or second quarter of next year?
Well, I mean, these levels are generally elevated anyway, right? And compared to history anyway. So I think $80 oil is historically a relatively high price compared to the last average of the last 10 years or so. But I do think that the upside is coming from the China factor, also from the fact that inventories are pretty low generally across the world. Also, we have OPEC cutting production to try to support prices. And remember that the U.S. government has committed to, or at least announced, they're going to be buying oil if prices dip below $72 a barrel on WTI. And we've traded close to that level and bounced back up. So I think, you know, there's little downside, and yet you have all the China reopening ahead of you, which is likely going to add at least 700,000 to 800,000 barrels a day of fresh demand to the market.
Dial back the clock, Francisco, to let's say April or May of this year. Would you have suspected then that oil was going to close the year closer to $70 or $75 a barrel, or closer to 125?
Well, I mean, I can tell you what our forecast was. Our forecast was oil was going to end the year at 95. I'm talking about Brent, WTI at a little lower. So, you know, it's definitely been a little more negative than we anticipated. And I think part of it has been that Russian flows have continued to hit the global markets, despite the
How
European
is that,
sanctions.
and why is that? Is that a failure of sanctions? What is it?
Well, essentially, it's the price cap. I mean, the price cap was an instrument devised to keep Russian oil flowing into the market, because European politicians have committed to stop buying Russian barrels, and then the U.S. Treasury, I think Treasury Secretary Yellen came up with the idea, well, why don't we do a price cap instead? So flows continue, and that's what we've achieved. We have more oil than we need. And at least from Russia and relative to our forward balances.
And we want that Russian oil to come to the market because ... Because
if it doesn't come to the market, then we'll be in a very, very tight global oil market. Because Russia is the number one exporter, or used to be the number one exporter of oil in 2021, and number one exporter of gas. So we want those supplies to come in order to prevent tightening of global energy markets. That's exactly what the price cap achieved. It avoided, in my view, a policy mistake in Europe to essentially limit those energy flows.